Good morning, everybody. It's Thursday, April 11th, 5:26 a.m. Central Time. Grain markets are mixed this morning. May corn futures up 2 at 436 and a quarter. May soybeans down 3.5 at 1161 and a quarter. May Chicago wheat down 1 and a quarter at 557 and a quarter. May Kansas City wheat up 1 and a quarter at 595 and 3/4. May spring wheat down 1.5 at 650 and a quarter. Let's get to China and some corn purchases.
So it appears that China is purchasing corn from Ukraine. Ukraine is slated to export 600,000 metric tons of corn to China by the end of this month. Earlier this month, Ukraine shipped 360,000 metric tons of corn to the Asian country. In addition to all of that, in May, another 400,000 metric tons of Ukrainian corn is expected to make its way to China. Ukraine is anticipated to export at least 22 million metric tons of corn this season. Due to lower global prices and reduced domestic production, China is expected to import record amounts of grains and oilseeds this year.
We have a lot of conflicting headlines this week regarding China and corn. We're going to run through them. This Reuters piece suggests that China is buying corn from Ukraine. Vilsack said earlier this week, and we discussed this in yesterday's show, that China is avoiding U.S. grain because of political tensions, because of this deal in Arkansas with Syngenta, that sort of thing. And then Bloomberg was out this morning indicating that China is actually canceling Ukrainian corn, and that the cancellations come after Chinese officials asked traders to limit deliveries of foreign corn into bonded areas in a move aimed at easing domestic oversupply and supporting prices for farmers before the planting season. So no matter which of these headlines is true, I don't know that any of it is positive for U.S. export prospects. If China is actually canceling corn out of Ukraine, and Ukraine's got the cheapest corn available shipped to China, if they're canceling that corn, it doesn't bode well for any potential Chinese corn sale out of the United States to China. So I don't know. None of it's good. I don't know which rumor is true. A lot of this, I think this Bloomberg article in particular is like citing, reliable sources. We'll see what happens, but none of it's positive. And if you're looking for China to come in and buy corn and save us here, it's probably not happening.
So, a significant storm system is slated to hit the northwestern areas of the US Corn Belt next week. The Western Corn Belt will remain mostly dry over the next 5 days, with rainfall favoring areas of the Eastern Corn Belt instead. Forecasts, however, now suggest that a strong system of storms will hit areas of the Northern Plains and Northwest Corn Belt Monday through Wednesday of next week. Rain and then snow are possible. U.S. HRW wheat country in the southern plains may miss the rains. Western Kansas, western Oklahoma, and Colorado look to remain dry.
This is quite a bit of rain or precipitation. There's going to be some snow in here too in the Northwest Corn Belt during the first part of next week. So this is quite a bit of rain during what should be the very beginning part of planting season. So we've very quickly gone from a situation where things were dry to now all of a sudden when they'd like to be getting started in places like Iowa, you're going to see some rain next week. And that's not to say that there will be no progress, but it shifted a little bit wetter. There is some rain on the radar this morning. This is some scattered stuff over parts of Illinois, parts of Missouri, further south into Indiana, Ohio, that sort of thing. These HRW wheat areas in the southern plains, if you look at the production density map, western Kansas, western Oklahoma, and eastern Colorado are going to kind of be they're going to be outside the range of where these rains hit. Kansas City wheat futures were up 17 cents yesterday, where SRW futures were barely higher. Same thing with spring wheat. So there could be a developing story here with dryness in U.S. HRW wheat country in the southern plains.
So if you guys have not checked out our premium content, you sure need to do so. Joe, can you tell me about the video you put together with Brian Split yesterday?
Brian was on yesterday. Brian is fantastic with charts. We ran through corn, soybeans. I think we did wheat. We did cattle, we did hogs, we did sugar, we did silver, kind of looked at the technical posture of this stuff. This is really great information if you're trying to reference grain prices or key levels in terms of breakouts or breakdowns, that sort of thing. It really kind of gives you the lay of the land and a feel for how the markets are acting. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. It includes our morning email, which goes out every single business day at 5 a.m. Central Time. That deal is jam-packed full of information. It includes our premium videos. There's a new premium video every single business day. We talk about everything from grain marketing to weather to macroeconomics to charts, anything that relates to you guys and the business side of agriculture for the most part is all stuff that we cover. Check this deal out today. It's cancel at any time. There's no other fee. There's no other obligation. Nobody will try to sell you anything else. This is the best way to support what we're doing here, guys. We don't have sponsors. We don't have corporate backing. Everything that we do is made possible through premium subs. So if you're a premium sub, we love you to death. If you're not, you should give it a shot.
U.S. consumer prices came in hotter than expected last month. The CPI rose 3.5% in March, up slightly from economists' forecast of 3.4% and higher than the 3.2% increase in February. Stocks tumbled following the report. The S&P 500 sank 1%, the Nasdaq dropped 0.8%, and the Dow Jones fell 1.1% to its lowest close in almost 2 months. Investors are now expecting only 1 or 2 quarter-point rate cuts this year, down from 6 cuts expected at the beginning of the year. The March CPI report represents the 3rd consecutive month that inflation data has exceeded expectations. And because of this, it's likely that the Fed won't cut rates until July, if not later than that.
It's more looking like September. September is now, if you look at the CME Fed tool and the implied rate situation based on the interest rate markets, it's looking more like a September cut. When you look at the increases over the last 3 years, things are much more expensive than they used to be. This is Charlie on Twitter. Transportation up 35% over the last 3 years. Fuel oil up 32%. Home prices up 31%. Electricity up 28%. Gas utilities up 25%. I mean, you get the idea here. Everything is a hell of a lot more expensive than it was 3 years ago. When you look at the annualized change in CPI, we've kind of leveled off here. We're doing, between 3 and 4%. And the Fed's target, I guess, is 2%, although they've kind of implied in so many words that maybe the actual target is closer to like a 2.8%. When you look at the actual index, it's at a record high. So if it feels like things are as expensive as they've ever been, they are. And that's based on the government statistics, which a lot of people don't believe to begin with. A lot of people believe that inflation is actually quite a bit hotter than what the government has anticipated. So this was bad for some risk assets yesterday. The stock market in particular did not like this. Does that mean that the bull run in stocks are over? No, inflation could go back the other way. And I think they've got that core PCE number out later this month, and that's the Fed's more preferred gauge of inflation. But not a good deal.
USDA will release its monthly crop production and WASDE report this morning at 11 Central Time. The report will feature only old crop data for the U.S. USDA will release its first version of the new crop corn and soybean balance sheets in May. The trade expects lower Brazilian production estimates and mostly flat estimates for Argentina. Few changes are expected on the old crop U.S. balance sheets.
I think we could see some changes on the old crop U.S. balance sheets. So we had this lighter than expected March 1 stocks number. And how do they account for that? I don't know. You can make a case for a higher ethanol, corn via ethanol number. At the same time, maybe you could make a case for a lower feed number. I'm sorry, not feed number, export number. When you look at soybeans, the trade's looking for like an unchanged carry out. I wouldn't be shocked if USDA cut the soybean export number based on the pace of sales and shipments. The South American stuff could get interesting. There was this headline out of Argentina yesterday. Argentina's Rosario Grain Exchange on Wednesday cut its forecast for the South American country's corn crop to 50.5 million metric tons, citing unprecedented damage by the spiroplasma disease carried by leafhoppers. I'm not a farmer or an agronomist. Don't ask me what that means. But they were at 57 previously, and they went down to 50.5. USDA is at 56 for Argentina corn. That's a material amount that could impact the balance sheets. So I don't know. This report typically or historically is not a huge market mover necessarily, but don't be surprised by a few changes.
U.S. ethanol production declined last week. Weekly output of 1.06 million barrels was down 1.6% on the week, but up 5.3% versus the same week last year. Ethanol stocks were pegged at 26.2 million barrels. The print was down slightly compared to the previous week, but up 4.3% compared to the same week last year. Implied gasoline demand was down a whopping 6.8% compared to the previous week and down 7.3% versus the same week last year. On average, over the last 4 weeks, implied U.S. gasoline demand is down 1.7% compared to the same period last year.
Ethanol production is very strong. It supports the case for a higher demand number. on the old crop U.S. balance sheet. Not enough to really move the needle and take you from bear market to bull market, but it's helpful. Ethanol stocks have almost undoubtedly hit their seasonal peak and should trend lower for the next 2 or 3 months, really through June or July. So this is the ethanol production, the soybean crush, all the domestic processing news has been very much positive.
We had another flash sale of soybeans on Wednesday. U.S. exporters sold 254,000 metric tons of soybeans to unknown destinations for delivery during the 24-25 marketing year. Year to date, this is the second flash sale of soybeans for the next marketing year, totaling 374,000 metric tons.
Unknown is often, but not always, associated with China. The spread between Brazilian soybean prices and U.S. soybean prices has narrowed. We're not quite competitive, but I'm not going to say that this can't be China. It could be. It's probably not. It would still make more sense for them to buy beans out of Brazil, but the spread has narrowed there, which is noteworthy.
Iran or its allies are expected to launch an attack on Israel in the coming days. The U.S. and its allies anticipate that Israeli military and government sites will be the target of the missile or drone strike. In response to the news, Brent crude surged above $90 a barrel on Wednesday. The conflict in the Middle East, which has been ongoing for 6 months now, has contributed to oil prices rising by 16% since the beginning of the year. Last week, an airstrike by Israel on an Iranian consulate building in Syria intensified the conflict between the two nations. As a result, Iran vowed to retaliate against Israel. The Biden administration has said that it will back Israel if Iran or its proxies launch an attack.
Yeah, maybe there's some sort of larger conflict or war coming. I don't know. Crude oil's been very strong. It's not like a runaway bull market. We're not going up $3-4 a day, but it's been trending higher for several weeks. My chart would indicate something near $99 is possible, and this is just one view of a chart. It doesn't make a huge difference, not a material impact here. But in any case, this is inflationary. It's inflationary and goes back to the rate cut thing. If gasoline prices get higher, it's going to disable the Fed from cutting rates. We're going to talk a lot about the rate situation in tomorrow's premium video. Jim Uriel is going to be on. We're going to talk about everything from the national debt to the impact of higher interest rates on government budgets and how much we're actually spending on the interest cost as it relates to the national debt, that sort of thing. But yeah, this crude thing is inflationary. Hasn't really helped the grain markets yet, though. What did cattle do yesterday?
They were once again pressured by the bird flu as 17 states announced import restrictions on cattle from states with confirmed cases of the disease. So feeders lost an average of $2.72. Live cattle lost an average of $1.57. Box beef also took a hit yesterday. Choice ended the day at $298.23. That was down $3.86, and select ended the day at $296.02. That was down $3.88.
I didn't see that. What is the specifics about which states and what are they doing?
There's 17 states that are now.
You don't have to name them all. But
okay, I was going to say there's 17 states that are now restricting the importation of cattle from states where the bird flu has been confirmed. So really quick, those 7 states where the bird flu has been confirmed is Texas, Kansas, New Mexico, Ohio, Michigan, and Idaho. And so they're not taking cattle from those states right now.
Well, that's not good.
Yeah, it is. I feel like it's going down a dark path and it's not necessary. And it's really going to hurt the markets going forward.
Yeah. Oh, all right. Outside markets on Thursday, guys. U.S. dollars about flat. Stocks are off again after a big down day yesterday. Bonds are about flat. Crude oil is down 60 cents and the May WTI at 85.61. We've got export sales this morning at 7:30. And remember, USDA at 11 a.m. Central Time. Have a good day, guys. We'll talk to you on Friday.